The US and other nations have been depleting their reserves. So they've got reserves in storage of oil. They've been using all of that up. And the US particularly has been draining that, and there isn't that much left. And that's the issue.
James Gruber, welcome to the business.
Nice to be here.
Just to begin with, an easy question. Make sense of oil, make sense of the oil price now, please.
It's the big question for markets really this week. So, you've had oil prices going up and markets going up at the same time. Oil prices going up makes sense because obviously the Iran and US have been at loggerheads, have renewed their conflict of tit-for-tat airstrikes. So it's logical that oil goes up because obviously there are fears that Iran will close or partially close the Strait of Hormuz.
And that's the central focus now, isn't it? The idea of controlling the Strait of Hormuz.
That's right, and that's really key. And the interim peace deal that they only signed a short time ago had opened that up and oil was flowing, and now there are question marks about whether that will continue, and therefore oil has gone up. It's been quite the round trip though. If you even look back to the start of this year, it started around $61 a barrel oil, went up as high as almost 120 by March and April.
Huge increase.
Yes, came back all the way back to 71 and is now up to 78. It's gradually come back the last couple of weeks up. So the volatility has been insane, and we've had to deal with it.
Do you see it going up? Do you see it going further north from here?
Well, if the war continues and escalates, you'd have to think so. If it doesn't, then it could retreat a little bit.
But you're in the markets though, so
yeah.
When you're at your terminal and you're looking at the markets, what are the key indicators that you're looking for to determine whether risks in the market have increased? Are there factors, variables? What are you looking for?
Well, obviously geopolitics is a big risk, and oil prices are as part of that. And we saw that, and the risk with oil going forwards is that if there is a closure of the Strait of Hormuz, and Trump has acknowledged this, that inventories for oil are extremely low across the developed world. If the Strait of Hormuz closes, how long can developed nations, including Australia, last without that oil is the big question. And some analysts suggest it could be 4 to 6 weeks before we start having to do things like rationing.
It feels, James Gruber, though, it feels like we've been saying 4 to 6 weeks for months. You know what I mean? Like, can you put a time frame around it where the world will run out of comfortable levels of oil supply before there is any kind of significant reopening of the Strait of Hormuz?
It's hard to pinpoint, but what I would say is the reason it hasn't happened is that the US and other nations have been depleting their reserves. So they've got reserves in storage of oil. They've been using all of that up. And the US particularly has been draining that, and there isn't that much left. And that's the issue. And it's hard to say exactly how much, say for instance, China has got in reserve, but that 4 to 6 week estimate is probably about right. And even Trump said, he acknowledged when the peace deal was done, he said, I basically did this. Part of the reason was because we face that oil crunch very soon. They were his words. So it can't be that far away, and that's the risk. That's the big risk for oil prices. They could spike again, and then we could have larger issues that we haven't really had to date to a big degree going forwards.
And the larger issues could obviously include some sort of market pullback or correction. We have seen what analysts are telling everyone, I'm sure your team at the Commonwealth Bank and CommSec are telling you, which is that it's the AI trade. We're seeing a lot of risks. The market continues to climb a wall of worry, but speaking of Wall Street, you've got just incredible enthusiasm still around AI, don't we?
Well, you have chip stocks that have been going absolutely bananas. The likes of Micron and SanDisk and these big chip makers, but they've been partially driven by profits as well. So an extraordinary statistic is that, for instance, Micron's profits are up 15 times over the past year, and they're about to overtake Apple's, which is extraordinary. It shows you that there is demand at the end of it. But the big question is that structural demand, or is it a bit of a cycle?
What do you mean by that?
What I mean by that is data centers are being built to cater to AI demand. Is there overinvestment? Will that come off? or will it continue to go up?
I guess what's the first indicator that you'll be looking for to tell you that it has gone too far?
Well, you're probably looking at a few different things. You're seeing some signs in debt markets where for instance, the Magnificent Seven stocks are taking on more debt to finance the building of AI infrastructure. Their debt, part of it is the yields are going up a little bit, which means that you're wanting more in terms of interest from that debt from those guys. That's one sign that you'll be looking out for. If there's a spike in those yields, then it's indicating, oh, we're not comfortable holding your debt given this AI center build out. That's one sign. Another sign would be the actual developers of AI centers themselves, and if they start to get into trouble. There's some of the signs you'd be looking out for. There've been minimal signs of that so far.
I just want to pivot a little bit to inflation and interest rates. There is, I guess, concerns that the Federal Reserve will hike interest rates or at least stop cutting interest rates. And Australia's central bank continues some sort of hawkish tone. The bottom line, James Gruber, is that inflation hasn't gone away. It's still sticky, especially services inflation. So where do you see the inflation picture for Australia? And just before you answer that, the RBA's chief economist, Sarah Hunter, said during the week that if inflation expectations were unanchored, the unemployment rate would need to rise in order for inflation to fall. Where do you see that going? Where do you see inflation heading? And do you think the Reserve Bank will have to hike rates to push the economy over?
Well, inflation has been sticky, and it's been more sticky in Australia than a lot of other places. We've got one of the highest inflation rates in the developed world at the moment, so it has been very sticky. And the RBA has been trying to deal with that. 3 interest rate hikes as part of that. Has it done enough? They're waiting and seeing. It's pretty clear whether that's the case. And a big driver of that is oil, obviously. If that continues to, say, flatline or go down, then that's a pretty good thing for inflation going forwards. And you have seen it tick down over the past quarter, which has been a positive, and that's probably going to flow into inflation over the next quarter or two as well. That oil
But the problem hasn't
down.
gone away.
No, it hasn't gone away. You're going to see that ticking down, and maybe overall inflation ticking down a bit, and that's what the CBA economics team is forecasting. And obviously, the big driver potentially of oil and inflation is the war ending, getting oil flowing, and getting that inflation down. But there are a number of other factors that the RBA will need to weigh up. As for whether interest rates will stay where they are or rise, that will depend on whether this inflation stays sticky and goes higher or recedes, as CBA economists think, and a lot of the market is assuming over the next, say, 6 to 12 months.
Yeah, it's a big assumption though. One word answer for this: Australian dollar against the greenback. Are you bearish or bullish?
Slightly bearish, just because what we've had is Australia was raising interest rates before a lot of the other advanced countries because inflation was stickier early here. But now you've got inflation a bit sticky in the US, and they're going to raise rates potentially by September according to the market. So if that happens, then all of a sudden you've got potentially US rates going up and maybe a bit of a strengthening US dollar versus the Aussie dollar. The Aussie dollar's been pretty good as well in the first half of the year. Slightly bearish, it might pull back a bit. Given those inflation and interest rate differentials, you had the US cutting rates only sort of 6 months ago or so. Now they might be raising rates. So that's a big difference going forwards.
Potentially good news for Australian travellers going forward.
Sorry, that wasn't a one-word answer, by the way.
That's fine. The travellers will appreciate it. James Gruber, it's been great to have you on The Business. Thanks for your time.
Nice to be here.